What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 3 high growth stocks that you should not miss out on in September of 2020. So just to give you guys a heads up, this is based on an article that I read from Investor's Place, as you guys can see. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice. We'll be going over these 3 companies that seems to be really attractive at the moment that we should either buy right now or hold on to, or like wait for the price to fall a little bit down so that we can invest in the company. Commenting, and we'll be conducting my own quantitative analysis to see whether those 3 stocks either belong in our dividend portfolio or our value growth portfolio by using this checklist. So if you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm. I really hope that this video saves you a lot of time in your research into these 3 companies. Now, without a further ado, let's get this video started. So 10 high growth stocks every young investor should own. Millennial investors should consider dialing up the risk, by Josh Enomoto, Investor Place contributor. Editor's note: the 10 best high growth stocks to buy for young investors was published in June 2020. It has since been updated to include the most relevant information available. With an influx of positive economic data ranging from the May jobs report to robust retail sales, high growth stocks have once again taken over the market. But for young investors that may have missed out on the initial run-up, they still have a great opportunity to participate in this sector. That's true not just because of the recent volatility, but also they have an asset money can't buy: time. Talk to any financial advisor, and more than often not, they apply the Pareto principle for 20 or somethings. Colloquially known as 80-20 rule, advisors recommend that young investors should have 80% of their portfolio in stocks and the remaining in a safer, interest-yielding assets. When it comes to millennial stock allocation, spring chickens should really consider high-growth stocks. As the saying goes, time is money, and in most cases, time is much more important. Like I mentioned above, you can't acquire more time, try as you might. Additionally, the present crisis has created big opportunity in risky but potential rewarding high growth stocks. As a young investor, you can wait out your speculative portfolio. With any luck, your target companies will reach their potential. This mindset is valid even with the impact of the novel CVPD. Indeed, young investors will likely look back onto the pandemic as an awful event that nevertheless transformed their financial trajectory. Frankly, there has never been a better time to buy great companies on discount. With that in mind, here are the top 10 growth stocks to buy for young investors. So out of these 10 stocks, and these are the 3 stocks that seems to have really sound fundamentals and growth potentials, and which I will be reading those part of the article, guys. So the first company in this list is Amazon, ticker symbol AMZN. Okay, so whenever discussion about high growth stocks arise, Amazon invariably makes most analyst lists. What's there not like? Not only does Amazon leverage an enviable track record in the market, but management also continues to forge ahead into new frontiers. Amazon is a disruptor among disruptors. Even in the age of the CVPD, Amazon continues to dominate among the high growth stocks. Obviously, pioneering online retail helps, but specific to the crisis, many traditional retailers face bankruptcy risks. That leaves Amazon to scoop up consumer demand. Additionally, as I discussed, Amazon is on the verge of unprecedented greatness. Those of you who are in your 20s or 30s have some recollection of a time when e-commerce didn't overwhelmingly dominate the retail sector. But we're so close to a generation coming of age that has no clue about the prior brick and mortar hegemony. When Generation Z enters the workforce en masse, they will buy through Amazon and other e-commerce channels, no questions asked. Additionally, the company offers other relevant services that young people are likely to accustomed to, such as clouding computing. Finally, with the pandemic, you can't ask for a better catalyst for Amazon stock. Basically, Amazon has been doing social distancing and contactless deliveries before they were a part of the cultural lexicon. Now, looking at Amazon stock, let's have a look at the current price to earnings ratio. Just type in AMZN, the ticker symbol. That comes down to 121, and compared to the S&P 500 index, just by going off the price to earnings ratio, Amazon is no means at a discount. Now let's see if Amazon can meet a part of our dividend portfolio. So checking AMZN. So in order for a company to meet my dividend criteria, these are the 4 rules that I like to follow. And these are based upon the principles that are mentioned in this book. These books that I've taken out and slightly modified so that I can get the maximum returns. So the first thing is that the dividend, the current free cash flows must be positive. So we want to be making sure that the company that we're looking at is able to churn out positive cash flows rather than bleeding money. Rule number 2 is that the dividends paid out should not be more than 75% of the free cash flows. So meaning that 25% of the current free cash flows can be retained by the business so that they can do other profitable ventures in the interest of the shareholders on behalf of the company. Now, rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. If you want to be on the conservative side, I would be looking for companies that are paying dividends for the past 10 years or growing its dividends for the past 10 years, my mistake. And rule number 4 is our buy criteria. We only want to be buying into a company when the current price is greater than or equal to the 5-year dividend yield average. Looking at Amazon stock, we can see that it does not pay out any dividends. Since dividend is the main selection criteria for our dividend portfolio, as a result, it cannot be a part of that. Now, let's see if it can be a part of our value growth portfolio. And the value growth portfolio is based upon these 3 books, and the rules are as follows. So the number 1, the return on invested capital must be positively greater than 10%. I put a star besides it because I might look for companies that are less than 10% if I think that it has a really good strong fundamentals and growth potential, and if the company really resonates with me. So the higher the number, the more profitable the company is. The rule number 2 is that it needs to have a consistent net current cash flows. So meaning that the company should be generating positive cash flows, that's a must, and we should be able to project the cash flows into the future to a certain extent based on the current previous trends. Now, rule number 3 is that it needs to have a strong balance sheet. We want to be making sure that the long-term debt on its balance sheet can be cleared off by the management, either by its free cash flows or its current assets within 6 years or less. Now, rule number 4 and rule number 5 are buy criteria. We only want to be buying the stock when it is at least at an 80% discount from its fair price, or 80% of its fair price, meaning that it is at least at a 20% discount from its fair price at which we should be buying the stock. Sometimes if rule number 4 isn't met, we can look at rule number 5, which is basically based on price to earnings ratio. We want to be buying the stock when the price to earnings ratio is less than the 5-year highest price to earnings ratio for the same company, and definitely cheaper than the S&P 500 index. Now, looking at this, we know that Amazon does not meet the rule number 5 as well, because it's definitely expensive when compared to the S&P 500 index, looking at its current price to earnings valuation. Now, looking at Amazon, we can see that the return on invested capital is 15.20%, so definitely meets the first criteria. We can see that it's been undulating here and there, but currently the return on invested capital is positive and more than 10%. Now, the revenue, it's almost like a straight line, guys. You can just draw a line across it from the starting point to the end point, and it will reflect that. And the free cash flows as well, it's been growing exponentially. Let's see how fast. So back in 10 years from now, it was around $2.5 billion as the free cash flows. So let's see how many times it's doubled. 5 double is 10, 10 double is 20. Now it's around 21. So around 25 to 30% year over year increase over the past 10 years. So definitely the free cash flows have been growing, and we can project it to a certain degree based on the previous trends here. Now, looking at the balance sheet, it has around $33 billion, which it can easily wipe off with its current assets. So the current assets are nothing but the assets on the balance sheet that can be liquidated into cash within the 12 months if the company decides to do so. So definitely a strong balance sheet because it can clear off its long-term debt within 12 months. Looking at the intrinsic value calculation, we can see that the earnings per share is $26.01. And in order to multiply the earnings ratio, we do need to get the price to earnings multiple. Looking at that, we can see that it's been trading 70.68 at its lowest and 1005.75 at its highest. So definitely at a discount when compared to the 50% of the highest price to earnings multiple, but it is definitely expensive when compared to the S&P 500 index. And the analysts are estimating that the company could grow somewhere around 36% year over year. All right, looking at that, it would put the company projected intrinsic value at around $29,000 share price, and the fair price at which we should be buying the stock would be $6,797, ideally at a 20% discount. If you want to consider it like with the proper margin of safety with a 50% discount, you should be buying the stock at $4,248 or less. Looking at the current valuations, Amazon is at a massive discount, more than 50%. So I would definitely consider buying the stock with its current valuations, guys. So the price is $3,149 per share. And in terms of value perspective or a growth perspective, so yes, it's definitely a buy as it is providing more than a 50% discount currently at the moment. Now, let's have a look at the next company in this list that I've selected for you guys. It is Square, ticker symbol SQ. So Square appeal is immediately recognizable to anyone who observes business trends. Though the Great Recession deeply hurt small businesses, the subsequent recovery saw many of them pick up the pieces. Particularly, the rise of technology innovations helped smaller companies compete more effectively against their larger counterparts. The impact has been such that today, companies value agility and the specialization more than outright size. What makes Square stock a compelling investment is that it evens the playing field for small businesses. Square provides portable credit card readers that attach conveniently to your smartphone, that enables entitles ranging from sole proprietaries to small corporations to quickly set up a payment platform. Another factor driving Square stock for the longer term, an increasing number of Americans are going cashless. Logically, this means we should see fewer cash-only businesses moving forward, and the type of business that would have once had been cash-only will likely gravitate towards Square's unique and convenient solution. If you needed more confirmation about Square's relevance, look at the price chart for Square. Since early April, shares have been steadily marching upwards, given its stability, to allow its small business clients to compete effectively in the new economy. Square is a buy both now and for the long run. Okay, pretty bullish there. And yeah, I do get that they're trying to make the payment platform accessible for all kind of investors here. And it's currently at a price to earnings multiple of 308 when compared to the S&P 500 index. So definitely on the expensive side for sure. And as it doesn't pay out any dividends, can be a part of our dividend portfolio, but we can see if it belongs in our value growth portfolio here. So looking at this, the return on invested capital is 16.07%. It's definitely a yes. So this is the first time in many years since its initialization since 2014, the company has been able to return a positive return on invested capital. I see a lot of potential for this. As a result, we would still consider this stock. Now, looking at the free cash flows, it has been growing consistently year over year. If you were to look at it when it started turning positive, we can see that it has been growing nearly at 100% year over year increase currently. So net cash flow is definitely a positive. If you were to look at the long-term debt, it's around $2.2 billion, which it can easily clear off with its total current assets of $6.187 billion. So definitely a strong balance sheet. And if you were to calculate the intrinsic value, it's 62 cents per share currently, earnings per share. And we can see that Square has been trading at the price to earnings multiple of 48.83, and the highest was 268.81. and the analysts are expecting that Square should be able to grow at a rate of nearly 35.59%, which is somewhere in line because over the past 3 years or so, it's been growing nearly 100% in terms of its free cash flows. So this would value the company at around $683 10 years from now. And considering a 15% return on investment year over year, the right time to buy the stock would be when the company's at $194. And if you were to consider a 20% markdown, start buying the stock when it is at $155.46. Looking at the current valuation, it is providing more than a 20% margin of safety at the moment. So as a result, I would consider buying the stock at this current valuation at a value in terms of a value growth perspective because of it meeting our fourth guideline. And since the price to earnings ratio is definitely expensive when compared to the S&P 500 index, we know for sure that it cannot be a part of the rule number 5 of our value growth portfolio. Now, looking at the last company in this list that I've selected for you guys is the Trade Desk, TTD. Prior to the CVPD, Trade Desk was one of the most compelling high growth stocks available. Naturally, an increasing number of people having to cut the cord over the years thanks to streaming services' inherent flexibility and convenience, features such as on-demand content and paying only for what you want particularly appeals to younger consumers. Given this demographic shift, it's imperative for advertisers to maximize their footprint in this new platform. Utilizing data and the next level market research, Trade Desk provides the clients with their effective advertising campaigns that target specific audiences. Plus, the company's aging agility enables advertisers to keep up with the consumer trends quickly and seamlessly. Therefore, it's not surprising that the TTD stock has exploded higher. And the CVPD makes this story even more compelling. When CVPD began spreading across the United States, most states issued stay-at-home orders. This had the effect of creating a hostage audience for streaming companies. In that situation, the business model for Trade Desk became patently obvious, hence the resilience of the Trade Desk stock during this crisis. After the CVPD fades away, the bullish thesis will only get stronger. People will continue to cut the cord as they have. During quarantine, many folks have been undoubtedly converted to streaming. These are all net positive for the Trade Desk. So let's have a look at TTD's price to earnings ratio. It's 169.47, definitely on the expensive side. And looking at it in terms of a value perspective, like a dividend perspective, as it does not pay out any dividends, we won't be considering this as a part of that portfolio. Now let's have a look at it in terms of a value growth perspective. So TTD the return on invested capital is 21.51, and the lowest that I could find was 14.98. The revenues are nearly a straight line, but the free cash flows are undulating here and there with its peaks and troughs. But it is definitely a positive, but I wouldn't be and it has been increasing substantially from minus $16 million to $19 million. So it basically means that it's doubled in a way of over a span of since 2014, 2015, 16, 17, 18, 19, 20, over the span of 60 years. So the growth is okay. So the cash flows, we can project it to a certain extent, but I wouldn't be that confident like compared to Square or Amazon by looking at those previous charts that we did. And the long-term debt is $142 million, which it can easily clear off with its current assets of $1.4 billion within the coming 12 months. Now, calculating the fair or the intrinsic value of the company, we can see that its earnings per share is $2.48, and TTD has been trading at a price to earnings multiple of 37.22 and 207.66. And the analysts are estimating that the Trade Desk should be growing around 25% over the next 5 years. So looking at these projections, 10 years from now, the stock price should be somewhere around $923.87 per share. And the fair price at which we should be buying the stock, considering a 15% return on invested capital, is $262. And the right time to buy or entering into the stock is $210.10. This is definitely a stock that we want to be looking at, but not at its current valuations that we should go ahead and buy it based on the rule 4 valuation. I would put this as a waiting list on our chart, and this one is definitely a buy now, and a buy now for this one as well. So let me know what companies that really pique your interest, or what companies that you're going to do further investigation in to see if they meet, if you want to start buying those companies, if it really resonates with you. So now the closing remarks, guys. So a former senior business analyst for Sony Electronics, Josh Enomoto, has helped broker major contracts with Fortune Global 500 companies. Over the past several years, he has delivered unique critical insights for the investment markets as well as various other industries including legal, construction management, and healthcare. As of this writing, he is a long SHRMF stock. Okay, so if you guys have stayed around till this part of the video, thank you so much, guys. It would be really great if you guys can smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos in this channel. Just remember, we post from Monday to Friday around the same times. And full disclosure, guys, this video is for your education and your entertainment purposes only. Make sure that you do your own research prior to investing your hard-earned money in any one of these stocks, because investing in the stock market does involve risk of losing your principal amount. So thanks for watching, guys. Catch you in the next video. Peace.